and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, we have seen the base metal prices head for yet another week of decline, especially copper, which hit a 12-month lows and is headed for a fifth weekly loss. It's down by 15% in these 5 weeks. What also has seen a slide has been the lead prices, zinc and aluminum, which is trading at a 3-month lows. What the markets would be watching out for in the next week is the summit where the President Trump and President Putin will meet. The investors will look for hints on the US sanctions on Rusal, whether it's going to be eased, lifted or tightened. That will tell you on how the base metal prices will trade in the next week. The bright spot in the metals clearly was in steel, where you saw the rebar hit a 10-month highs, the low inventories and also the weekly steel stocks declining for a third straight week was supportive. It wasn't just rebar. If you look at the hot rolled coil prices, they hit a record high as well in this week itself. What saw a decline, though, was the crude oil price. It's the second straight week of decline for this one, and the Brent and the US crude prices were down 4% in this week. The markets took cues from Libya, where they were talking about reopening their eastern ports for export. Also, that US may grant waivers to buyers of Iranian oil led to some premium off prices. But IEA has warned that the global spare oil capacity is stretched, and that is the reason you did not see the crude oil prices completely collapse. Joining us on the show today is the team from S&P Global Platts. First of all, Mriganka Jaipuria, welcome to the show. What is your sense really when it comes to the crude oil prices? Because we have seen a huge amount of volatility, the China-US trade war, Libya supplies coming on board, and then, of course, the speculative selling that took the knee-jerk reaction on prices. What is your sense? Where are the crude oil prices headed from here?
I think, Manisha, if you look at what's happening in the oil markets, if you look at all the pressures governing the oil market at the moment, volatility is going to be the only certainty in the months ahead. So I'm not entirely surprised by the market's volatile price movement, given the US's announcement that it is considering imposing a tariff on additional $200 billion worth of Chinese goods. And of course, the fact that Libya, Libyan exports have resumed, the market is basically reacting. It is a knee-jerk reaction to that. But if you look at the markets fundamentally, structurally, in the months ahead, the market is tight. There is supply tightness. You've got Platts Analytics estimates that about 1.3 million barrels per day of Iranian crude could disappear from the markets once the US sanctions on Iran take effect on November 4. That is a large volume of crude disappearing from the market. Libya, while yes, NOC has resumed exports, it's still a very volatile situation. We were actually a little bit surprised by the resumption and what happened between the Libyan National Army and NOC, and the situation is still very fluid and volatile. I mean, Libya lost about 700,000 barrels per day of crude output when the situation...
Absolutely. There has been plenty that has been happening, Mriganka. But what is your sense on the crude oil prices moving from here? The fundamentals are plenty. What is your sense on the range for rest of 2018 now?
I would like to quote our Platts Analytics number here, and yes, we are expecting prices to stay in the $70 to $80 range going forward. And one of the reasons why, I mean, of course, it all depends on how demand gets impacted and demand and how the US trade war against China and the rest of the world unfolds, and the impact that has on GDP growth. Because what we've seen is oil demand is more impacted by GDP rather than absolute oil price at these levels. Demand is still relatively strong. Indian demand is growing at a very strong pace, driven up by the manufacturing and construction sectors. Demand in China is fairly strong as well. So overall, oil demand is growing, though we've only reduced our oil demand growth estimates very modestly at the moment. So on the demand side, I think the biggest risk that the market is facing is how the U.S. trade war is going to pan out, and what sort of impact is that going to have on GDP. On the supply side, we have Saudi Arabia and Russia committing to producing additional volumes in the months ahead to try and ensure a balanced market. There are some question marks around the level of spare capacity that they have, but they will be pumping more, and that could keep a lid on prices in the months ahead.
Well, that is something we will have to keep an eye on. But the volatile crude oil prices, I mean, we've seen 2 to 4% of a move on a daily basis, is clearly not good news for consumer countries, especially India. How do you see India in that light?
Well, the consumer countries certainly have to be ready for this oil price volatility. Where Iranian supplies are concerned, yes, we don't think the entire 2 million to 2.2 million barrels per day that they export will disappear from the markets in the months ahead. The US may grant some exemptions. I think the countries that are already reducing crude imports from Iran, Japan and South Korea, are going to continue doing that. India may seek some exemptions, and China is there. China has been very quiet on this front. That's probably because they want to see how the trade, the trade war between China and the US, the rhetorics have gone up, and it is creating a lot of ripples in the market.
It is. And because, it's not just the crude oil. We have seen all the other asset classes also take an impact from that. But let's also get in the show Chris Midgley, who is head of analytics at S&P Global Platts. Chris, hi, a pleasure to have you on the show. What is your sense on crude? What do you think the sanctions on Iran will see? Do you see an impact on the supply side scenario in crude with what's happening with Iran right now?
Yes, this is significant. Of course, everybody got worried about, taking Iranians' exports to zero. I don't think anyone ever thought that was going to happen. But what we've seen is that the US administration has done everything they can to persuade OPEC to put more barrels onto the market, 2 million barrels. But we know that there just isn't 2 million barrels of spare capacity. And so not surprisingly, we're now just seeing the administration taking a little bit more softer stance, providing some waivers to companies, especially here in India. It'll be interesting to see what they do to some of the Chinese companies. It's still, the secondary sanctions are still going to impact quite a lot of companies, especially in Europe, and companies which got exposure to US banking. So we're going to see about 1.3 million barrels a day of lost exports from Iran around the 5th of November when these sanctions apply. We're already starting to see exports dropping off into Europe. So it is going to be significant, and there's still a challenge for OPEC to meet that deficit of supply come November.
How do you think the spare capacity issue will really play out in the oil markets? Because we have seen the IEA come out and report that. Also, how do you look at the crude oil prices moving forward from here now? Do you see it breaking range, or do you see it really staying within where we're trading right now?
I think this is a signal that we're really at a knife edge. You've got, if we say it's 1 million to 1.5 million barrels of spare capacity in OPEC, that's less than, it's only 1% of total demand. So, it takes only small swings in supply. So we had 350,000 barrels that's been taken out because of the Canadian upgraders problems that they've got. The swings in production from Libya, you have this swing from 200,000 barrels a day to exports up to 500. These are enough to move the market significantly. And so I think we are going to continue to see quite significant volatility for the time to come. Where is the market heading? I think the market is reasonably well supplied. There's not a need, in my mind, to go above $80 significantly. The reason you'd go above there is if we needed prices to create a demand response, high oil prices stemming some of the demand that we see today in this relatively healthy economic outlook. So therefore, oil prices feel like they are going to trade in the $70 to $80 range. We see it being tight going into November as the sanctions start to bite, and therefore probably see oil prices in the high 70s for that period of time, perhaps softening into 2019. But as we go into 2019, we've got new challenges that the oil market's going to face, which is the IMO bunker specifications, which will be applied in 2020, which are likely to again give the market a little bit of price support.
All right. So next 2 to 3 years, crude oil prices are expected to be on the higher side. But, you know, there is this constant threat of production coming in from many producing countries. And even as Saudi Arabia and Russia may try to fill this gap, what is your sense on the global supply-demand numbers now?
I think the reality is we talk about them cutting production. The reality is the only people cutting production has been UAE, Kuwait and Saudi Arabia. Most of the others have been cutting or losing production because of demand problems. Places like Venezuela, Libya, Nigeria, it's all been disruptions in their supply. And so OPEC has been struggling to meet the quotas. So this is the agreement. The agreement is to raise production up to the quotas that were agreed originally. So they've been over-complying, and that's tightened the market faster than perhaps they would have liked to. And the agreement is that they will allow more flexibility to the likes of Russia and Saudi Arabia, who have the spare production, to increase it in order to get to the quota levels.
All right, so that really is the view coming in. Chris, thank you so much for joining us. Mriganka, you too. So that's the view really, that the crude oil prices are supported from here. 70 to 80 is the range for this year, but the crude prices will stay on the higher side for 2019, even 2020. With that, let's go for a break, but stay tuned. We have more views coming in on the metal space, which have seen a decline in this week. Also LNG, which is quite an evolving market in India.